Hey there, welcome to the channel today. So today I want to go over two stocks in particular that really ramped up and had big up days on Friday. Okay, so I'm going to look at two stocks that had big up days on Fridays. We have Affirm, and then we also have Carvana. And I want to take a look at them. So first of all, Affirm has been one of these stocks that's kind of gotten the crap kicked out of it. Affirm is one of these buy now, pay later companies. So they're financing, extending credit. And of course, they're, a high tech kind of company. So they kind of embed it well with the app and they kind of make partnerships with different retailers so that it's really easy when you go to check out. It's like, hey, you offer an Affirm option. They give you, an option where you don't pay any interest if it's a short amount of a loan, longer loan, then they're charging, interest and telling you, what it is. So that's all fine, except, the reason this thing is selling off, I think, is part of the issues. We'll go into that. They haven't been profitable yet, and then the other issue is, if we are going into recession, if retailers are having issues, consumers are having issues due to all the inflation, it doesn't have really a great prospect. But in spite of this, what we did see is a 9.45% move on Friday. Okay, so let's go look at Affirm then. So it had this huge move on Friday, but in the big picture, this sort of means nothing, right? So, I mean, if you're looking at it and you're saying, okay, well, we had this big move. I mean, look at it's like nothing. In compared to all the volatility of this thing, this thing was trading not even 6 months ago at almost 170, call it, and we're down in the high teens. So it's really gotten the crap kicked out of it. So I think the first thing is to look is like, why did it go up? Was there any reason, any news came out? So I'm looking around and yeah, so what I found is Market Watch had an article. And so apparently what happened is so let's read this article from Market Watch. Shares of Affirm holdings were surging 9% on Friday session after analysts shared the company's positioning despite its recent pressure. Okay, so basically, there's a couple things. They're acknowledging that, yeah, there's now new competition from Apple Pay. Apple apparently is going to have this option to pay later. And so that directly competes with Affirm, who is, like I said, their goal is to put this button, at you check out from retailers, and then they'll extend you the credit. Here they're noting shares have fallen 28%. Now, this analyst apparently thinks that macro pressure can reduce competition in the market, while Affirm has advantages in underwriting and funding, which he argues investors aren't giving enough credit. While it's tough to predict the economy is heading, we believe Affirm's remarkable growth trajectory will continue. Remarkable growth trajectory. Okay. So let's take a look at that. We're going to go right now. We're going to go jump to the fundamentals that I've done. Okay, looking at this fundamentals. So here we're looking at quarterly, and this should be the way this would be is 127 million in revenue for that quarter, 26 million virtual card. So what you can see here, we're in the income statement and we're talking on the quarterly basis here, and you can see, total revenue is increasing, right? So we went from 204. So let me just try to annotate. Yeah, so we went from earnings, December 31st, 2020, we had 204 million, 230, okay, 261, 269. So you can see the earnings are growing. And, like I've said on this channel before, when I do these fundamental analysis, high growth is good. And this is, of course, an issue with the stock market. They love the high growth, but let's see what's happening. How much of that is making it down to the bottom line? Well, one of the issues that you're going to know is look at your total operating expenses here. If you look at your total operating expenses as a percentage of your total revenue, 154%. Okay, so I'll give you a hint. Any number beyond 100% means you're losing money. Okay, so it's bad. Now, what's happened though, they were at 113%. Okay. And then 173%. So it got worse and then it got a little better and then it got worse again. And now they're at 154. So when you're looking at this, now you can see because of the large expenses, and you can look at the different areas, loss on loan repurchase is 18%, provision credit loss is 15%. That's pretty high credit loss provision. 15% of your revenue you're expecting to have it as a loss. That's kind of interesting. Funding costs, et cetera, et cetera. But then one of the ones really, you have two parts. You have the sales and marketing here, right? And general administrative. So these two things here are nearly 70, 80% of their revenue is spent on sales, marketing, and SG&A. So the end result is, look, it's very simple. This company has not made any money ever that I see here. It's losing significant amount of money, which is a huge potential problem. In addition, so what is this analyst talking about? I mean, I don't know, and I'm not accusing, I'm not doing any of that, but like this guy is like living in the clouds. You have a company here that what should they be focused on? The more money they make on the top line, the more money they lose on the bottom line. I mean, look at it. Here they went from 269 million to 361 million. And instead, what happened over at the bottom line? Well, they lost 166. Now they lost more because basically their expenses are going up. They're just losing more money. The more they sell, the more they lose because of all the costs that they have. And they don't have enough money to cover that cost. So a firm, in terms of just my opinion, I don't know anything about anything, not financial advice. I'm like, this one is kind of just a joke to me. It's like, okay, this one's really, and trust me, when we go into, we are most likely in recession. When you're in recession and people start losing their jobs, which is coming, they're going to, what is the first loan that they're going to say, I'm not paying? It's going to be these, because this is on like furniture, crap like that. You know, what are you going to pay? Right? Really, what are you going to pay when you lose your job? First of all, you're going to pay your housing. You're going to try to stay in your housing as long as you can. Then you're going to, try to pay your car, but then you're going to cut back on everything else. Anything you paid for furniture, whatever, they can't get it. It doesn't matter. And important to understand, you don't care about your credit at that point. You don't give a crap about your credit. You're like, look, and I'm trying to survive here. I need to keep food on the table. And then the next thing that will go, right. So you're going to be like, try to hang on, reduce expenses, try to get a job. If you're not able to get a job quickly, because most people are living paycheck to paycheck, even people apparently with like 30% of people with making 150 or more are living paycheck to paycheck. Okay. So, they don't go very far. Once you lose that job and it's not coming in, there's several things that you have to do. First of all, you have to cut your expenses rapidly. Then if you're not able to get a job quickly, you have to figure out what you want to do. Do you want to liquidate whatever savings you have? So people making 150 might have some 401k stuff. Maybe they got 50 or 100k in there, possible. Okay. So that means stock market hits, right? They're going to start doing liquidations of that. After that, what are they going to do? They're still going to try to keep that place to live. So next thing is the car. Now, before you go and you hit your, once you get down to that point and you start dipping into your 401k, then you're like, okay, look, I'm letting the credit cards go. And once you make that decision, I think most people realize, hey, forget it. I don't care about my credit. So first, they're going to dump the Affirm stuff. They're not going to make those payments. Middle finger, we're not paying you. They'll probably pay some of the credit cards, right? Because the credit cards give them access to cash, right? Access to cash and access to some spending. So you can imagine the hierarchy. You're like, look, I want to pay my housing payment, so I still have a place to live. I might, once I realize my credit's gone and I'm going to have to take that hit, and I've drained a big chunk of my 401k, and I realize, okay, my retirement's gone, et cetera. I mean, this is literally what happened in the financial crisis. This is the kind of the hierarchy, and trying to figure out the hierarchy of what people are going to give up. They're going to try to use whatever money they have. And then after that, they're going to pick in it. At some point, when you give up on the credit and you say, hey, I'm done with the credit, they're going to start defaulting all this stuff, all the firm pays you go. They're just not going to pay that very early on, right? They'll take the hit to the credit, and they'll try to hold on to a credit card. Like, you try to hold on to one credit card while you're defaulting on the others. And yes, that means they can come back and the other ones can shut you off, et cetera. But you're going to try to play the game as long as you can. And at some point, you're just going to be like, you don't care about your credit rating. You don't. And that will happen really, really fast. So I think my perspective is that Affirm they were, quite honestly, they were toast before the Fed started raising interest rates. I mean, look at 15% provision for credit loss, 24%. I mean, don't you understand what that means? 15% of the earnings, like, all other things considered, they're expecting like, well, we got 361,000 revenue, and we expect, 15% of that revenue to be lost due to defaults. It's like, that's crazy. And it's always been on the high. That's better than the 24% that it was lower. So you can see how it's like, okay, financially, they're just done. So look, my perspective, paper trading, nothing involved, a firm dog poo on a stick. Now let's go to the next stock. Okay, the next rally stock for Friday was Carvana. Carvana, let's see, 13% move on Friday. Interesting. So big move there. We'll kind of see, look how it's pressing up against this previous high here. You know, maybe you can get a little bit of a breakout, but who knows? So yeah, that's kind of interesting. So what happened here? So I searched for this too, and we go to Motley Fool and we see, you know, why did this stock soar today? Well, it turns out that, and I haven't even looked at the presentation, but I'll just take it on, you know, face value. On Friday, used car company Carvana released a 53-slide presentation outlining how it intends to cut costs and generate free cash flow. And apparently the market is a big fan. So, okay, so let's see what they're doing. According to management, factors in used car, blah, 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 compelling to profit. Okay, so here's a really interesting thing, and actually I would think a positive thing. According to Carvana, factors in used car industry, the economy, and financial markets are all compelling it to prioritize profitability over growth. Profitability over growth. Okay, let's go take a look at the financials. Okay, looking at Carvana financials, amounts in millions. So first of all, they're kind of a bigger company. Used vehicle sales net 2.7 billion worth of sales in the last quarter that we have. Looking at the vertical analysis, you can see that they had a gross profit margin of 8.5%. Okay, but they did end up with a loss because of various expenses in their SG&A. But let's look at their trend, at least what they were trying to do. If I look at the vertical analysis over here, let's look at the gross profit. And as a percentage of sales, it's your gross margin. So that here we had 10%, 12%, 14%, 15%. So what do we see as a trend? We see that the gross margin has been improving on a yearly basis all the way to 2021. Now we see that you can see how the business has deteriorated. In the first quarter of 2022, it dropped to 8.5%. However, gross margin was positive, so that's good. However, this wasn't large enough to make up for the fact of their SG&A and other expenses. But here's the key to this. And so this is where I would applaud Carvana for being, you know, very like looking in the right direction. So what Wall Street loves to look at is this number, the growth, year-over-year growth of the sales, right? And look overall, so growth of 100%, 101%, that's for the year 2019 over 2018, then growth of 41, then growth of 129. Now, what they said is they need to prioritize profitability over growth. And that, from my perspective, is 100% correct. Look, they lost the profitability here. And if this profitability deteriorates anymore, well, first of all, they had a larger loss. So on a quarterly basis, they lost 500 to 6 million. And these are yearly basis back here. I mean, they never lost that much money. They lost more money than they've lost in any previous year of their existence from 2018 to 2022. So you got to understand that this business rapidly deteriorated. They lost a boatload of money. And you got to understand that that takes the risk of, like, if you're going to be a going concern. Now, what is the response of the company? If I just take on face value what they're saying, from my perspective, they're doing the right thing because they understand what the problem is. They don't need to come out and say that, oh, we grew in this year, 2022. They don't need to come out and say that, look, we grew another 100%. That means nothing, because if they grow at 100% like this, losing $506 million a quarter, but get the growth up, they're going to be gone. They're going to be like bankrupt. They're going to be gone. So at least I would salute management in this case that they realize what the problem is. Profitability is the problem. Right. So they have to fix profitability. And that means certain things. They have to be able to increase the gross profit. So that means the cost of sales, they have to drive that down. So whatever that means in a car business, they have to be more picky or more careful when they're buying cars to not overpay for those cars. That's number one. Number two, they have to try to get, better pricing for the cars. Most likely, and the biggest thing is this SG&A. They're going to have to lay more people off. They're going to have to, which they've already apparently done that, and they need to improve that because they need to operate more efficiently, right? Because at this point they had 298 million, millions, 298 million, and they spent 727 million. So, now a couple things. You can't get rid of 727 million. You'd be lucky if you knock that down 20%, but so you have to also grow on the top line. But what you have to do is you have to grow profitably. They're going to have to, in that slide deck, whatever. So I don't know what they did. But all I'm trying to point out here is at least they're looking at the real problem. So this is what you want to kind of maybe think about when you're looking at companies. Like at some point, if they're growing in the gross margins of, it's like you own a small business, you own a bakery, a little store, any kind of little store selling widgets, selling lemonade. If you set up on one street corner and you're losing money on selling your lemonade at that one shop corner, why the heck would you want to go to 10 shop corners and lose money? Right? You're just having to spend money, so basically what that means is, like, if I'm selling lemonade on this one street corner and I'm losing money on it because I have to spend, $1.20 for every dollar lemonade I've sold, that means, if I want to sell more, my sales are going through the roof. Well, yeah. And you have to kick in 20 cents per lemonade that you're selling. You're just losing more money. Why would you want to expand that business? You shouldn't. However, in Wall Street terms, there's a myth in some sense where it's like, well, no, you can grow out of it, because if you grow those sales, and of course I understand it's a difference between the fixed cost and the variable cost, right? So it's really the difference in your cost of sales. But the key part here is this has to be big enough, and it's not. That's what this tells you. At 8.5, look, when they were at 15%, they were a lot closer. They were a lot closer to being able to do something with their SG&A to recover that. But, at this kind of a number, it's just too much. So, yeah, so that's it for this one. So I think really my guess is, if we look at these stocks again, I think what's happening with these stocks is that, you probably have a short squeeze. You probably have a bunch of shorts in here that made some money on this. And if you were short this thing, anywhere in here, look, even if you had shorted this thing, even here, way here, even if you were really, really late to the short and you somehow shorted it at 40 and you got almost down to 20, in many ways, you'd be silly to not take profits. And given Carvana trying to move in the right direction, they're trying to move to get towards profitability. What does that mean? Are they going to be profitable this year? No way in guacamole, P. No way, dude. However, they'll end up, if they are taking the focus where they need to take that focus, they could last a lot longer. See, they're playing a game right now, and the game is, now it's survival. We're going to have to ride out this recession we're going through until we get on the other side, and then we can try to regrow the business. That's the game they're on. And if you want to be short that's a really tough one, because if they do have any success of making the thing drag out longer and you want this thing to go to zero, it could be a tight exit for the shorts. So I think that's probably explains a lot of that. And if you were thinking, of course, from the negative side, paper trading only, that you were going to go in short now, you missed the bus. You missed the bus is my suggestion. And keep in mind what that also does. It potentially, there's now way in speculation, it potentially, if that company is surviving longer, and if they have something to their business model or something that other people want, it means that maybe they would be one of the buyouts, as compared to like Shift or Vroom, where maybe those companies have got so many problems that other big companies that might want to take advantage of the downturn that we're coming to, that they'd be like, look, we don't want to touch it. We don't want to touch this thing at all. But maybe something like Carvana, maybe they'd want to touch. And so therefore, if you short the thing, and even if they give them a modest, 20% buy positive of the current price, you could be in trouble. Why do you have such aggressive up moves in bear markets? You're not missing on anything, right? These huge up days mean nothing in the big picture. Nothing. I mean, look, this guy was a 13% move. I mean, I'm guessing that's at least another 13% move. It's these huge moves, but they mean nothing. You're always losing head. And the reason that's happening is because the short people are infinitely exposed. And so they have to run out the door, and they just got to protect themselves. If they have any kind of money management principles, they got to like, hey, I got to protect myself. But that's all I see. All right. That's it for this one. Hope this was helpful in some way.